All right, guys. Well, let's get this show on the road. If you say something enough times, it's bound to be true at some point. Um, so we have been talking about a new Fed chair for quite some time now, and um, in the last couple days, the president has kind of announced his nomination. Wasn't really a big surprise who he picked. Kevin Warsh seems to be the next Fed chair, pending congressional approval. But there's typically Fed chairs, unlike maybe some like secretary level, seats and administrations tend to fly through pretty well. There's more or less, generally speaking, somewhat bipartisan support, and I think that's because it is intended to be kind of a bipartisan, non-political role. Um, I'm going to talk a lot about the Fed share and what that could mean. Before we do that, I found some really interesting data points that I wanted to share with you guys today. So I'm going to jump into that first, some kind of market driven things. Then we'll talk about the Fed share, and then we'll talk about the market and get on with our day and hopefully survive Winter Storm 2026. You guys in South Carolina that are on the call today, that snow up there was kind of crazy looking. I'm not sure when the last time you guys got that was, but pretty wild. So, all right. So here's two interesting charts I found that talk about the movement of populations or people around the country. And the first is, let me stop my share because I'm trying to drag one other thing over here. The first is Florida specific. So for those of us in Florida, I think some of us maybe welcomed less influx of population, um, but a decline of population can be bad. So, as evidenced by other states. So here's the Florida numbers, and um, I think that for us, this is a good chart to show to our sellers. It's also a good chart to keep in perspective because Florida is still one of the leading states in the country, although not at the pace that we saw during COVID. So this is Florida net domestic migration. So people from within the US moving to Florida, and this is a number of persons count. Look at the surge from the 90s, really, through kind of pre-financial crisis, 66 to over 260,000 people per year migrating to Florida. Um, Fell off significantly. In fact, some people left Florida after the financial crisis. And then kind of a similar, build up really, through kind of the pre-COVID years. We had a year or two in Florida where it dipped, and then we had that kind of crazy pandemic surge, and then we've fallen off significantly the last couple years. Um, I think there's a couple reasons behind that. Okay, so one, Florida used to be, and for those of you not in Florida, this is kind of a precursor of what you might see in the future. So, Florida, for those of us that have been here a long time, used to be very, very, very inexpensive. Just thinking back to like our average mortgage amount or realtors, your average sale price, significantly less than it is today. So, Florida is not the cheap buy a house for $175,000 place that it was 15, 20 years ago. And so I think that's part of it. Fewer people relocating to Florida because affordability isn't quite as good as it was. I think you also had a lot of people during this COVID surge that got here and realized that it wasn't for them. Maybe that was the people, maybe that was the climate, maybe that was the economy. And so you're probably having well north of 22,500 people moving to Florida, but in the past, when there weren't many people leaving Florida, like I don't know what the numbers were, I'm just making this up, but like during COVID, that 310 net, that might have been like 330 moved here, 20 left, 310 was the net. Where today, maybe the number is like 50,000 or 60,000 came, but if 30 or 40 left, that net number of 20,000 is about as low as we've seen since right after the financial crisis. And so I think affordability is one. And I think others is more people are probably moving that weren't long-term, but short-term residents. And I also think that you have some people where people would retire to Florida because of the climate, no state income taxes, and affordability. And I think people might be spending their working years, rearing children in Florida and maybe relocating somewhere else. Maybe we're headed to South Carolina, Georgia, North Carolina, or Tennessee, where things might be a little bit more affordable. So just an interesting kind of pattern for us to watch. And then the second piece of this is here's your national numbers. And the national numbers here, this is per capita. So not the number of people. This is a per capita number. But South Carolina, you guys are number one in the country from July of 24 through July of 25 of per capita increase. So you've seen a 12% surge. Um, but if we look back like 5, 10 years ago, where did most people relocate? And this is kind of before and through COVID. They came to Florida, right? We're down to 1%, right? Per capita increase. Texas, a little bit in Georgia. Arizona was a big one. Ooh, a lot of mute there. Okay. And then what's changed? The states that seem to be booming the most have moved a little bit north. So it's not just a Florida phenomenon, or Georgia's maybe slowed down a little bit, or Texas has slowed down a little bit. Even Arizona was probably north of 10% for a couple of years. 4.1% per capita growth is still strong. But where are people moving? They're moving rather than Florida to South Carolina, 12, North Carolina 7.5, Tennessee 5.8. Look at Arkansas 4.6, Oklahoma 3.5, a little bit in Missouri, Idaho a big number, Nevada, Montana. Kind of an interesting thing here. You're seeing some people up in New Hampshire and Maine. I'm guessing probably leaving New York, staying in the Northeast, and maybe going, like Northeast versus South from New York and New Jersey. The states that have been losing a lot of people, New York is down big, New Jersey's down big, Massachusetts, California. Colorado surprisingly was down, and Colorado had been a big growth state. But we have lots of friends, and cross country has lots of offices and big market share in Colorado. Their prices have exploded, and so what's happened to affordability? Affordability has been a big challenge, and so I think where this map is going to go over the next 3, 5, 10 years is where are things affordable. So maybe people because you guys in South Carolina can probably tell more than I can, but you're probably seeing prices increase, and you probably have a period of time where things are really affordable. But at some point, maybe you guys, maybe it's 3 years, maybe it's 15 years from now, you might see what Florida has been seeing the last year or two, which is prices are higher, it's not as affordable, less people relocating or moving. And so maybe they moved, to, Kentucky could be a state, right? Maybe one state north. You're seeing very little growth in Virginia. That was a boom state north of, kind of on the DC suburbs. Virginia's gotten very expensive. Virginia's gotten very tax heavy. So 0.7%, very, very moderate growth there. In Alabama, which is, outside of a couple of cities, a very rural state, had some pretty big growth. Places like Birmingham are growing pretty good right now, and that's all affordability driven. So really interesting chart to watch. I think for your sellers and buyers, both of these kind of tell a story. On the selling side, especially for those of us in Florida, um, it's lack of buyers, a lot of listing inventory, a lot of competition. That's probably a softening mechanism for home prices. In South Carolina, the message might be to buyers, there's a lot of demand moving into South Carolina. I'm guessing, over the next period of time, you're not going to see as many deals to be had. Maybe more things are selling at listing price, or maybe you have some multiple offers if you have a big surge of population. So certainly, all real estate's local, as they say, but just really interesting trends to follow. If you guys would like a copy of these, of course, just get with whoever you guys work with on our team. I thought those were really interesting tools to share today. The last two I've got, then we'll jump into the Fed chair in the market. So this is something we've talked about a lot on the call for the past really probably year or two, that kind of the wage gap or the wealth gap, if you will, is continues to widen. And I've shared this on this call in the context of who is it easy, like who can afford a house right now and who can't. And younger people, less skilled labor, lower income, they're more stagnant. And if you look at this blue line, those incomes are increasing at a smaller percentage. And then like the very top, quartile of incomes has gone up significantly, really kind of since like the 2023, kind of peak of inflation. And so that gap is widening, which is it's troubling because it makes it harder for certain people to buy houses. That's one of the reasons why the average age of a first-time home buyer has gone from 28 in the 90s. It was in the early 30s, like 31, 32 for many, many years in the early 2000s and teens. That's 40 years old right now, kind of the nationwide average age of a first-time home buyer. And that's because, where are first-time home buyers on the income scale? They're younger, right? Less experience. They're making less money than someone that's got 20, 30, 40 years in the workforce. Um, and so until this self-corrects, and this number doesn't need to come down, this number just needs to go up, right? This number needs to be more in line. I saw another chart over the weekend, and I didn't share it, but it's along the same lines. And I'll ask this in the chat with you guys. Who do you think is more impacted by inflation? And let's just say the blue line or the green line. Who is more impacted by inflation between the two? Okay, and I've got the blue line, right? And why is that? It's because number one, they're living thinner, right? More paycheck to paycheck, less room for error, right? Less savings. More of their income is going towards, food and shelter and things like that. And then the things that people buy that are more impacted by inflation tend to be things that impact everybody. And that would be, food, auto insurance, things like that. Um, and so it's going to be really difficult and I think a slow, long process to get things where they're really affordable for everyone, especially your younger first-time home buyer, don't make as much money types. Like that first-time home buyer age is troubling and probably something that none of us on this call like because we probably think back when we bought our first house or all the first-time home buyers we've served over the years and how exciting it is sometimes to help someone that's younger buy their first house because you just know, what the next 20, 30, 40 years in their life of real estate and how that can create wealth. Like we know the benefits of that. And so it's a troubling phenomenon. I don't think there's really anything that the government can do to fix that. I know the president's talking a lot about affordability tools and how to bring rates down, and that can help a little bit, but certainly there's no quick fix. It's just going to be something where the economy is going to have to fix itself and adjust over time. Um, okay, and then the last thing I've got, and this was really interesting. So for many, many, many years, foreign governments invested a lot of money buying U.S. bonds, treasury bonds, mortgage bonds, and U.S. bonds were considered a safe space to park your money. For a long time, China and Japan were massive holders of U.S. government debt. Not that it was they were trying to like buy up our debt. It was a safe place to park their money and there were some currency reasons for that as well. The dollar is kind of the world's reserve currency. That started to change as you have emerging countries like China and India and Brazil that are bigger players on the world stage. You have the EU collectively, that's a massive economy that rivals the US rather than them being individual countries that are minor in scale compared to the US economy. And so you're seeing more and more people invest in bonds in other countries and focus less on maybe dollar manipulation. That's not good for interest rates because if there's more people buying bonds, that drives the price of bonds up and that drives the yield or the rate down. And so, one of the reasons why we talk about 5.5 may be the floor as low as we can see rates going this year. It's because of one of the reasons is supply and demand. There's not as many foreign governments or outside of the U.S. interest buying bonds that would drive yields down. On the other hand, if you've got your money in the stock market or if you've got money in a 401k, it's been a heck of a run for a couple of years, right? As bad as the bond market has been and as high as rates have been, historically speaking, the last couple of years, the stock market's been the opposite, and it has been on fire. And it's hitting record levels, whether that's the S&P, the Dow, the Nasdaq, the QQQ, whatever. It's if you're in the market, you've been crushing it. That Twitter feed I follow, Kobayashi Letter, talks a lot about this, and they basically say you need to own assets because the only way to expand is owning assets. You are not going to get anywhere by like debt reduction. It's asset accumulation is kind of the game right now. And it's because the markets have been on fire, crypto. And yes, they all have peaks and valleys, and silver, had booming highs and then a huge sell-off last week. But generally speaking, like asset classes have really been booming the last couple of years. Um, and what's interesting here is that this chart shows foreign percentage of equity, so stocks. So what percentage of the stock market do foreign entities own? And you can see that for many years, 10, 13, 15%, it kind of got over, pushing 20 in the, 2010s, and, all-time record, basically, really highest since like the 1970s or late 60s. 32 and change percent of US equities are owned by foreign entities. So one of the reasons why the stock market's been booming is because foreigners have been pumping money into the US, buying US equities. That money had to come from somewhere. It probably came out of bonds into stocks, right? And so when money flows from bonds to stocks, the stock market rallies, the bond market sells off, and interest rates go up. And so until this changes, that's probably a reason why mortgage rates and treasury rates will be stubbornly high and probably can't get beneath that 5.5% number, because a lot of the people buying bonds are now in the stock market. So again, interesting stuff to share. Um, as always, if you guys want any of these slides, just message whoever you work with on our team. We'll get them in your hands. All right, so here's the big news of the day, and this was interesting. I'm not sure if any of you guys on our team just saw this. So Aaron, this went from like 3 basis points to 45, I think, since we started the call. Am I crazy, or is that
ISM.
accurate?
Yeah, the ISM just rolled out.
Yeah, but I think this is more Fed Governor Warsh than anything. Um,
Got it.
So, but maybe it could have been that. Okay, so um, Trump has been talking for a long time about his new Fed chair, and there's been names floated. And Kevin Warsh, and I've linked his Wikipedia page here, and I will put it in the chat if anybody wants to grab and look at his bio, which is very impressive, by the way. I mean, he's got a very, very strong experience bio, seems to be a very qualified candidate. But the president has talked about wanting rates lower. We're on percent mortgage rates. Um, I've shared my personal opinion, just my personal opinion, that I don't think that's the message we want to send. I think the Fed needs to remain independent, and the Fed needs to move, as markets dictate. And I also understand why the president wants lower rates, right? So can understand why the president wants lower rates, but maybe not agreeing with, the manner that, he wants them, to get lower, because there's only so much the Fed can do. So there's been a lot of talk of, will Trump hire a yes man, or will he hire someone with a backbone that's going to say no? I think Kevin Warsh tends to be someone that's going to say no. If you read his bio, he was one of the only people that dissented to a lot of the bailouts in 2008. So he was kind of a George Bush appointee, one of the youngest ever Federal Reserve governors. He was 35 years old, like in 2006 or seven, when he was appointed a Fed governor by former President Bush. He would be considered an inflation hawk. A hawk means willing to fight inflation. I don't want to cut rates too much. I want to keep inflation low. So he's an inflation hawk, which is a little bit interesting because Trump really wants someone who's a dove, someone who wants to, push rates lower, and which could maybe lead to inflation. So it'll be interesting to see how his nomination is taken. The bond market is all over the place this morning. Like, we were down 2 basis points, then 45, and then we're down 20. I think we all need to like kind of take a deep breath and let the market play out for a couple days. But there's two things that'll be remain to be seen. How is Kevin Warsh going to act as Fed governor? So he was a very, very strong inflation hawk. He resigned from the Fed because felt like the Fed was too loose with easy money, too stimulative, too much quantitative easing, all things that artificially lower rates during COVID, post 2008 crash, but then also caused inflation to spike on the backside. And so Warsh is very much a hawk on inflation, but at the same time, he is very tight with President Trump, very, very close ally, big supporter of his, campaign donor, very, very close to the president. And so the market might say, in one hand, he's a hawk. On the other, is he so close to the president that he's going to do what the president wants? And I think the reality will probably be somewhere in the middle, but it remains to be seen. What I think we want him to do is take a very, very strong stance on inflation when he first takes office. If he takes a strong stance on inflation when he first takes office, and I shouldn't say takes office, his first public comments, right? He's basically the Fed chair today, even though he's not officially the Fed chair till he's confirmed it, and that's a few months out. But he's the Fed chair, right? Like things he says will move the market more than anything Jerome Powell can do, right? Jerome Powell is effectively out, even though he's still in charge. What Warsh says, the market will take his opinions, his policy, his comments, interviews, things like that. That'll give us an idea of what direction the Fed's going to go. But I think we want him to take a pretty hawkish stance and really just kind of root out inflation, keep it moving in the direction it's going, which is cooling. Um, I think if he gives some speeches that's too dovish, like more likely to cut rates, that would actually, and this is counterintuitive, but that would probably cause mortgage rates to go up. And I think this little bouncing around you're seeing today is the market just trying to get a footing. There's probably a lot of money flowing in and out today on that announcement, but we don't need him to take a dovish stance initially. That would lead to some inflation fears, which would cause rates to go up. And so if we kind of go back in time, if you guys remember in 2024, we've talked about this a lot. We had a really, really nice bond market rally. Interest rates came down, got down near 6%. The Fed cut in the fall of 2024, inflation spiked, and then the bond market sold off, and rates went back to 7% until like early part of 2025. So if Fed chair or soon to be Fed chair Warsh takes a dovish stance and inflation spikes, mortgage rates will shoot up, and they'll shoot up drastically. So we need him to kind of take a hawkish stance, which is I'm going to fight inflation. I'm not going to cut till it's appropriate, and then let his actions a few months from now, be dictated by the market. There's another good article I found here, just an AP, just a little bit of bio, stuff about him. I think it's just good to understand who he is and what his background is. I'm going to pop this in the chat as well. If you guys want to grab that, if you're driving and you want these two, just message whoever you work with on our team. We'll get it to you guys. And then here's what I think is going to happen with the bond market. So right now, what you're seeing, and this is actually kind of cool for you guys to see real time, these technical numbers. So this purple line here is called the 100-day moving average. The black line's called the 50-day moving average. And all these lines are like the average bond price over a period of time. And what you saw earlier today when I first jumped on was that the bond market was down 45 basis points. That's like an eighth to a quarter in mortgage rates. That's a big, big move. And now it's only down 19, which probably isn't even quite an eighth in rate, but it's not a huge market mover. It's like within the intraday. But what happened here, which was interesting, was the bond market this morning, probably right at the open around 10, sold off and went below this 50-day moving average, and then it quickly bounced higher. That's actually a good sign of stability. It's okay for the bond market to sell off a little bit today. We've had a couple good days, the last few weeks. Things have been, pretty flat. The positive sign is that we sold off a lot and then the market rebounded very, very quickly. What that means is that the bond market's not ready to go down here. That's positive for us. That's kind of the opposite of what happened earlier in January. If you guys remember that day where the president talked about buying mortgage bonds, the bond market rallied and we went above this resistance level and then quickly turned around. Like the media was like, rates are 5.9 out, and all of us are like, rates are 6 1/8. What happened to 5.9 out? It was like lasted for like 30 seconds, right? A quick rally, a quick sell off. The market wasn't ready to go that high in bond price or that low in rate. The opposite is happening today. That's a good sign. But none of this really matters right now in the big picture, grand scheme of things. What matters is we have a new Fed chair appointee over the next days and weeks. What he says, what indications of Fed policy that he gives will certainly be market moving. And we just want him to be a little more hawkish, which means he's not going to let inflation creep back in and get out of control. I'm pretty confident that's where he'll be. And I think he'll have to do a little bit of a political dance with the president who's appointed him, who wants rates lower. And he'll just have to make sure Trump understands that, and I think he does, that they can't cut rates and push them lower if inflation's not where it needs to be. And so if we continue on the trend we've been, that's slightly lower interest rates. Just got to be careful of what the next week or two, what they say. Um, if we go to the Fed watch, this is kind of the predictions of future Fed meetings. Nobody's expecting a cut in March. Nobody's expecting a cut in April. 50-50, maybe 60-40 to the yes that we might get a cut in June. So the market is kind of expecting him not to do anything and to follow the track that Chairman Powell was on the last few months, which is waiting for inflation to get below 2%, which is really the Fed's target. And so I think he'll probably continue that course of action for a period of time. But the market doesn't want him to be dovish. They don't want him to say, we're cutting, we're cutting, we're cutting. So that's kind of the things we're going to watch. There probably won't be a lot coming from Warsh directly anytime soon, but you'll get some hints. And so we'll talk more about this next week and the week after. If there's any hints he gives and how the market reacts to it, we'll share it with you guys. Last thing I've got for you guys, we did a class for those of you in Central Florida last week on some of our non-QM programs, things like bank statement loans, DSCR, asset depletion, things of that. If anybody would like for us to do that in your office, if you've got an office or a team meeting, let us know. We'd love to come do it in person if you guys weren't able to make the class we did here. Same goes for everybody in other markets, South Carolina, South Florida. If anybody either wants us to put on an event or come to your office, we'd happily do that. We're going to do something very similar in February. For those of you in Orlando, where we've got a date and time booked later this month, we'll do the same in other markets. But we're going to talk a lot about the buy before you sell programs and kind of really dive deep into if someone wants to buy a house not contingent upon selling their existing, how do you do that? How do you do that from a qualifying standpoint? How do we get them the cash to buy a house if they haven't sold yet? How do we make sure their debt to income ratio works qualifying for a new home without selling the existing? So we've got a number of programs that work within that kind of overall buy before you sell program. So if you guys would like some more information on that, we'll be putting some events on here later this month as we kind of get into the spring buying season and you have that question coming up with more and more buyers. So with that, guys, we'll let you run.
Hey,
Have a
Mike,
great day. Go ahead,
you
Duba.
want to, yeah, you want to mention the Tom Ferry event on the 19th?
Think we did last week, and I posted the invite in the chat. But yeah, again, if anybody would like to attend, um, Tom Ferry, #1 real estate trainer in the world, he has events in Orlando, Tampa, Miami, Atlanta. I know a bunch of South Carolina people are talking about coming to Orlando for that. Um, and I don't know if the Miami logistics have been totally announced yet with like web links to give you guys registration information, but I know the Central Florida one, the Orlando one that a lot of us are participating in, we've got links. And so, yeah, if you guys would like to see Tom Ferry, just get with whoever you work with on our team. We will get you guys a link to sign up for free. We are the keynote sponsor, so we've got a bunch of free tickets to give away. So should be a good event. He is awesome. If you haven't seen him live, he is full of energy and a lot of really, really good ideas. So um, appreciate you guys jumping on today. Have a great day. Have a great week. And we will see you guys next time. Thanks, everybody.